give a type of money that can only be spent for a specific number of reasons. And some worry about that state control or whatever. But like in this particular narrow use case, you want to give checks to individuals to get the economy moving again.
Yeah.
So if you think of programmable money that expires if you don't spend it.
Today, we will consider a proposal to replace the federal banking agency's risk-based capital framework for large banking firms with a new framework that will be applicable to banking firms with at least $100 billion in total assets and to firms with significant trading activities. And second, a proposal that would modify the risk-based capital surcharge for U.S. global systemically important banks. The U.S. banking system is sound and resilient with strong levels of capital and liquidity. A robust and dynamic banking system, along with effective and efficient regulation and supervision, helps to ensure that banks of all sizes can meet the needs of households and businesses in every community throughout our country in good times and bad. We must preserve and build upon these strengths in that diversity. Following the global financial crisis, the banking agencies implemented a series of reforms to increase the strength and resilience of the financial system. The development and implementation of the Dodd-Frank Act and the Basel III Accords followed a deliberative and thoughtful process that evolved over a period of several years. And I supported the outcomes of that process, which in some important ways did exceed the Basel minimum requirement.
Welcome to the Crypto Teacher. And you know I come back with that video just to make you think.
Don't forget to like and subscribe to the channel.
And guys, once again, the Fed is getting ready for the fourth industrial revolution. This new digital economy. We know Basel III is a global agenda. And we see that they're raising capital requirements and all the banks have to be on board by 2025. And we know that's when the United States is going to flip the switch on the fourth industrial revolution. And we see technology slowly coming behind the curtain, but it's definitely going to speed up next year. And as technology speeds through the economy, we know it's going to cause mass layoffs. And that's why it's so important for you to understand the technology so you don't get caught on the wrong side of history and you don't fall for the devil's tricks. We know when it comes to the banking system and real-time settlement, it cuts out all the fees that these banks were making. And now that the Fed is cutting risks, it's going to cut even more profits. But we know banks like JP Morgan, Goldman Sachs, BlackRock, Vanguard, they are already set up for the fourth industrial revolution. They were invested in the digital assets from the beginning. But now that we're going to start seeing a consolidation in the banking industry, we know that these small businesses are not going to survive unless they get themselves ready for the fourth industrial revolution. And we know 90% of them don't even know it's coming. They're busy working hard and taking care of their family and paying bills. And we know by the time the sheep wake up, the robots, algorithms, and drones would have taken over the economy, and they'll get that carrot dangled in order to get that free money. So therefore, they can enter into the metaverse. But little do they know that money is programmable, telling them what, where, and when and how to buy, and they have 3 to 6 months to spend it or poof, it's gone. And remember, the Crypto Teacher told you, because he knows. When it comes to the New World Order, it's all planned out. You have a wonderful day.
This has been, kind of foreshadowed by the Federal Reserve Vice Chair for Supervision. This is really tough stuff.
It's tough stuff, but as you say, it was telegraphed, most of it by Michael Barr, the Vice Chair for Banking Supervision. And as you can see, bank stocks didn't move that much in response. The KBW Bank Index was down 1.2%, but it was a risk-off session anyway. The S&P was down itself about 0.7%. But we did get the details, 1,000 pages worth of details, Kathleen, including the 19% capital boost that's mandated now. And for even smaller banks, so banks with about $100 billion in assets, that's going to be 16%. So banks were expecting it, but it's still now put in black and white. Not just that, but to make banks bear the responsibility for their own risk-taking, The regulators also want banks to start to use two different methodologies when they're calculating their risk-taking, and then pick the one that results in a higher level of risk-weighted assets. Banks won't love that because, of course, it'll mean a little bit more stringency when it comes to that. Michael Barr's message: this will better align capital requirements with risk. Banks say, well, yes, but it might make us less competitive, especially against some of our European aligned competitors, the likes of Apollo, the likes of Blackstone, hedge funds, and so on.
Bonnie, how much pressure would these proposals put on banks, assuming no changes?
Well, banks have time to respond, and you know that they're going to say this is going to put a huge amount of pressure on us. You know they're going to say it's going to crimp our ability to have share buybacks, it's going to crimp our ability to release dividends and so on. But just to put it into context, Heidi, banks from 2020 to 2022 raised about $137 billion in share buybacks. So when you think of that, it's $137 billion. The cushion that they've built up for this since the great financial crisis is about $121 billion. It's not even close to what they've given out already in the last 2 years. So banks can raise this fairly quickly. Moreover, there is a 3-year transition period. The whole thing doesn't start till 2025. And the FDIC chair, Martin Brunenberg, says that with the exception of just 5 banks, the others have enough capital already to meet the proposed mandates, and those 5 could raise the capital fairly quickly. So if banks complain that, you know, they don't have enough in cushion, it's not going to go over with regulators as a really big complaint.
However, one clear message was that regulatory requirements, including capital requirements, must be aligned with actual risk so that banks bear the responsibility for their own risk-taking. The proposal takes an important step forward to better aligning capital requirements with risk, both for the specific risks that were in play this spring and for a much broader set of risks that banks face. As staff will explain in more detail, there are 2 proposals today. The first would update our capital standards to better reflect credit, trading, operational, and derivative risk for banks with $100 billion or more in total assets. For a firm's lending activities, the proposed rules would end the practice of relying on a bank's own internal estimates of their own risk, and instead use a standardized but risk-based measure of credit risk. Standardized credit risk approaches do a reasonably good job of approximating risks, while internal models are prone to underestimate such risks. Second, for a firm's trading activities, the proposed rules would adjust the way that a firm is required to measure market risk, which is the risk of loss from movements in market prices. These changes are intended to correct for gaps in the current system. For instance, the proposal would provide less credit for diversification across risk classes, since correlation across risks can change dramatically in times of stress. The proposal would require banks to use a standardized risk-based approach for hard-to-model risks. In addition, the proposal appropriately requires more capital for positions that are less liquid, in order to better capture the risk of illiquid trading positions. Third, for operational losses, losses from inadequate or failed processes, such as from fraud or cyber attack, the proposed rules would replace an internal modeled operational risk requirement with a standardized measure. The proposal would approximate a firm's operational risk charge based on the firm's activities, and increase the charge based on a firm's historical operational losses to add risk sensitivity and provide firms with an incentive to mitigate their operational risk. Fourth, the proposal improves the capital treatment for derivatives activities by introducing a standardized but risk-sensitive measure of valuation risk due to changes in counterparty credit. The second proposal would help to ensure that the surcharge applied to globally systemically important banks better reflect the systemic risks that each GSIB faces. In particular, it would make adjustments to limit so-called window dressing, reduce cliff effects, and improve how we measure some systemic indicators, better align them with risk. These changes are designed to improve the risk sensitivity of the requirements. The changes are expected to increase capital requirements overall for banks with $100 billion or more in assets. But I want to emphasize that they would principally raise capital requirements for GSIBs, the largest, most complex banks, better reflecting the risks their activities pose to financial stability. Increases would be small for large banks that are not GSIBs. Banks under $100 billion in size without significant trading activities are not affected by these proposals. Community banks are not affected by the proposals. To put these changes in context, recall that banks are, by their nature, very leveraged and fund only a small portion of their assets with capital. The proposal would raise capital on average by 16%. One can think of the proposal's more accurate risk measures as equivalent to requiring the largest banks to hold about an additional 2 percentage points of capital, or an additional $2 of capital for every $100 of risk-weighted assets. Staff has conducted extensive analysis on the economic impact of the proposal, which can be found in the preamble to the final rule. Specifically, this analysis suggests that the benefits of a robust financial system, as well as resilient financial institutions, outweigh the cost to economic activity that may result from additional capital. With respect to lending activities, staff analysis suggests that the capital impact on these activities would be modest, and the greater resilience provided by the rule would contribute positively to economic growth by enabling firms to continue to serve as intermediaries and providers of credit through a range of economic and market conditions. We also intend to collect additional data to refine our estimates of the rule's effects. These changes would be implemented with an appropriate phase-in, which will allow ample time for banks to adjust their balance sheets and activities and to build capital over time. In fact, most banks already have enough capital today to meet the new requirements. For the banks that would need to build capital to meet new requirements, assuming that they continue to earn money at the same rate as in previous years, we estimate that banks would be able to build the requisite capital through retained earnings in less than 2 years, even while maintaining their current dividends. Additionally, this proposal has already benefited from a robust development process, and I'd like to briefly outline some of that. Work on the market risk framework began shortly after the global financial crisis, more than a decade ago, and the international negotiations on the full set of reforms concluded in 2017. The agencies, including many of the people at the table today, began work on what would become the proposal shortly after that agreement. The pandemic delayed the proposal's launch, but work continued up to and after my arrival at the Fed. We held countless meetings with our sister agencies and briefed the board's Committee on Supervision and Regulation. Staff have met with individual members of the board and provided many helpful analyses and supplemental information regarding the proposal. We have heard from and engaged with banks, industry groups, public interest organizations, academics, and members of Congress. And all Fed governors have had the opportunity to review the substantive materials and get detailed briefings from staff since early June. The proposal has benefited from this robust process and culminates with what is in front of us today. And now we're finally at the stage where we can get more data and feedback and identify areas for refinement. I want to emphasize that all comments will be carefully considered. We'll be vigilant in working to avoid unintended consequences, and I encourage commenters to provide us their analyses on all of the issues presented. The extended 120-day comment period is appropriate and will allow all parties adequate time to fully analyze the issues presented in the rule. We'll be attentive to those comments and look forward, as always, to the public comment process. We welcome comments on all aspects of the proposal, but I will mention a few areas in which I will be particularly interested in reviewing public feedback and analysis. For instance, we are aware of concerns the overall increase in capital requirements would be significant, and I look forward to comments in that regard. There are, of course, both costs and benefits in this space, and I believe that we would be mindful of both and hear the views of a wide range of parties. We have heard concerns that the proposal, when combined with our stress test requirements, might overestimate market and operational risk. We want to ensure that the rule is supportive of resilient and liquid financial markets. I look forward to comments on how specific activities may or may not be affected by the proposed changes. In addition, we want to ensure that the capital rules support a vibrant, diverse banking system with banks of all sizes by applying capital requirements appropriate to the size and risks of institutions. The proposal does adjust the size threshold for capital rules, and we will benefit from additional views on whether the benefits of that increased resiliency outweigh the costs. And finally, we want to ensure that the proposal does not unduly affect mortgage lending, including mortgages to underserved borrowers. These are several areas that I will pay close attention to and encourage thoughtful comments. Any rule will only benefit from a diversity of well-reasoned and good faith arguments. I look forward to the comments we will receive. I'd like to end with a reminder of why capital requirements are so crucial to our nation for safety and soundness and financial stability. Neither regulators nor bank managers can anticipate all risks or how risks may be amplified and propagated. Events over the past few months have only reinforced the need for humility about our understanding of the causes and consequences of financial stress, and for an approach to capital regulation that makes banks resilient to both familiar and unanticipated risks.
The changes that are proposed today, we can reasonably foresee that there could be significant unintended consequences. Regulatory costs are passed through to consumers and businesses for banking products and services. Regulatory costs can also lead banks to discontinue or reprice certain products and services. And importantly, regulatory costs can also push activities into the shadow banking system. Have we considered how this proposal might impact the cost and availability of banking products and services? Or would there be a shift of these services and activities to non-banks? And how do you plan to address these concerns during the rulemaking process?
So thank you, Governor Bowman. I'll take that one. So that the potential for impacts on cost and provision of banking services was certainly a large part of the impact study that we conducted, along with in collaboration with the other agencies. We looked at that in terms of differentiations and different types of banking activities. So in the lending space, as Vice Chair Barr mentioned at the beginning, our estimates that the all-in aggregate costs or the all-in aggregate increases in capital requirements to lending products would be modest, something, but still modest. And when we looked at that and compared that to the benefits from the resilience, we saw that the benefits did outweigh those costs. We also looked at the potential that differences in costs across different credit products, credit cards versus mortgages versus commercial loans, et cetera, if those differentials were inappropriately calibrated, they could lead to banks having an incentive to reallocate across those different portfolios. And we did not see significant differentiations that would prompt that. So in the lending space, again, the conclusions of the impact analysis were that the effects, if any, would be quite modest. Trading, as we've mentioned, is an area where the estimated impact of this estimated increases in capital requirements would be substantial. And so again, we looked at the balance between the benefits to resilience and the bank's ability to continue to serve as intermediaries, even under a stressful market situation, versus the potential costs that they would bear, their clients would bear, or potentially that it would create an incentive to move out of certain businesses. Those are risks that we still acknowledge. The literature is somewhat ambiguous as to how increased capital affects those things. And I would just emphasize and go back to the data collection that we are planning. So the idea of trying to get estimates of the increases in capital for specific trading areas and sort of views from the industry and the public for particular areas where there might be a disproportionate impact would be certainly an emphasis that we would be looking to analyze.
Going to a different economy, and we're going to be learning more about that as we go, but clearly we're learning that things can be done from remote locations. We're learning that technology can replace people even more than we thought.
We're not going back to the same economy. We're recovering, but to a different economy, and it'll be one that is more leveraged to technology. And I worry that is going to make it even more difficult than it was for many workers.
In Silicon Valley, and my friends who work in technology know that what we did to the manufacturing workers, we are now going to do to the retail workers, the call center workers, the fast food workers, the truck drivers, and then even bookkeepers, accountants, insurance agents, lawyers, and on through the economy. So what happened to the manufacturing workers is a very clear sign.
And so we'll import Chinese-based CBDC technology. So it's going to be CBDC in a box provided to you by the People's Bank of China.
But every stock, every bond, every currency, every commodity, every piece of art, every private business, every piece of real estate will eventually be a token on a blockchain, an entry on a ledger, permanent and immutable. We will have truth instead of trust, and we will save over $7 trillion a year. 6 to 8% of global GDP is wasted by the friction of the trust industry that's necessary when you have dual entry accounting. With triple entry accounting, which is what a blockchain is, we get rid of all of that friction. It's a beautiful future.
Like what you see in China and their social credit scoring systems, right? If we get identity wrong, it could be a tool to enslave humanity. And if we get it right, it could be a tool to liberate humanity. And as an American, I'm obviously rooting for the one that's on the side of freedom.
Bitcoin is an international asset. And also, I do believe the role of crypto is, it's digitizing gold.
I actually believe this technology is going to be very important. Look at it. We have been part of the huge revolution in investing through ETFs. We believe that ETFs will be changing the whole way we invest. Many people still use it as a means, people are investing it for indexing. No, the majority of people who are putting money in in ETFs are active investors that are buying exposure. The entire bond market is being transformed as we talk right now. I believe the next generation for markets, the next generation for securities will be tokenization of securities. And if we can have that distributed ledger that we know every beneficial owner, every beneficial seller, we all have our code of who's buying, who's selling, instantaneous settlement. And think about it, it changes the whole ecosystem.
Crypto Teacher and the new World Order book, plus the 3 kids books. It's time to re-educate. Also, new to cryptos, Coinbase, Bitrue, Binance. Do not forget book links and crypto links are in the description. The stock channel, guys. Don't forget to go like, subscribe, spread everywhere. You have your Kobo, your chip stocks, your banking, your gaming. While everybody's sitting at home, get home stocks, the Xrp, the biotech stocks. And while everybody's at home wishing, they were still getting that free money. What are they doing? Drinking and smoking weed. Don't forget about those stocks, and you have a wonderful day. The most powerful person in the world is the storyteller. The storyteller sets the vision, values, and agenda of an entire generation to come. Steve Jobs. And guys, I truly believe in this. When you look at the New World Order, they're the storytellers. And that's the reason why I wrote my New World Order book. But guys, now it's time to change the current generation. And I wrote 3 kids books. I love the Trinity because I understand the power that's in it. So I have 3 books. We have an opportunity to change the generation, to educate, not just me, but I want to show you that I take action on a daily basis. And I want you to take action on a daily basis. Whether it's your job, whether it's in your community, we have an opportunity right now to educate the masses. I posted this on my Twitter account. Please share, but this is a short clip of the 3 books. There's going to be a clothing line and action figures. Please get these books for your kids, nephews, cousins, friends, so therefore we can start the re-education now. Because as we see, the 4th Industrial Revolution foundation is definitely here. Robots, algorithms, drones, taking humanity out the picture. We have to re-educate. But let's get into the video.
Part 1. King Joshua and Grandma Tam save the village. Part 2. King Joshua and Grandma Tam save New York from COVID stories 3. Part 3. King Joshua and Grandma Tam goes to China.
It's mandatory to get part 1, part 2, and part 3 of this series. It's time to re-educate Generation Z.